Most people miss a critical reality when they look at their monthly mortgage statement. You see a massive debt balance, look at the interest rate, and your immediate instinct is to kill that debt as fast as possible. It feels like the ultimate financial victory, owning your home, free and clear. But the real math shows a completely different picture. By rushing to write that final check to the bank, you might actually be locking yourself into a permanent state of financial vulnerability. There is a profound paradox at play here. The action that feels the safest, eliminating your housing debt, often exposes you to the highest level of systemic financial risk. Today, we are going to look at the hard numbers behind the choice between paying off a fixed-rate mortgage early versus redirecting that exact same capital into capital markets. We will decode the behavioral traps that make the wrong choice look completely logical and simulate the exact life trajectory of both paths over a 20-year horizon. To make sure we are comparing apples to apples, let us establish standard baseline parameters using current United States economic data. For this calculation, we are assuming an average American household income of $98,000, which aligns with recent Bureau of Labor Statistics data for prime-earning professional households. We will factor in a long-term core inflation rate of 2.5%, consistent with the Federal Reserve's long-run target, and we will place our hypothetical homeowner in the 22% federal marginal tax bracket. Our property baseline is a home purchased for $450,000 with a 20% down payment, leaving a principal mortgage balance of $360,000. We are analyzing this under a standard 30-year fixed-rate mortgage at an interest rate of 6.5%. If you find yourself in this exact position, grinding through the early years of a 30-year amortization schedule, it's vital to understand one thing. If you feel overwhelmed by the sheer volume of interest you are paying right now, it is not your fault. The American mortgage system is structurally front-loaded to protect institutional lenders, not your personal liquidity. Let's look closely at the conventional choice. The traditional narrative, passed down through generations, says that debt is an inherent danger. Culturally, we are conditioned to believe that true financial freedom means living completely debt-free. And on paper, building up equity in your home seems entirely correct. When you pay an extra $500 a month towards your mortgage principal, you are receiving a guaranteed risk-free return equal to your mortgage interest rate, in this case, 6.5%. In a volatile world where the stock market can drop 20% in a matter of weeks, a guaranteed 6.5% return feels like an absolute anomaly. It bypasses market volatility completely. Furthermore, psychological ownership plays a massive role. There is an undeniable sense of security in knowing that no matter what happens to the economy, no bank can take your roof away. This choice leverages our natural aversion to debt and satisfies our desire for a clean, simple balance sheet. For decades, traditional financial advice has championed this exact strategy as the cornerstone of a conservative, responsible lifestyle. It feels right because it aligns with our deepest instincts for safety and closure. Here's what changes the whole calculation. While a guaranteed 6.5% return sounds excellent, a single pivot sentence reveals the structural flaw. You cannot buy groceries with home equity. When you over-allocate capital into your primary residence, you fall victim to a psychological phenomenon known as mental accounting, where you value money differently based on where it is stored. The real math shows that home equity is the most illiquid, inaccessible form of wealth available to an individual. Let's peel back the hidden costs layer by layer. Layer number 1 is the liquidity trap. When you inject an extra $500 cash into your mortgage, that money is effectively trapped. If you face a sudden career disruption or a medical emergency, you cannot easily extract that money. To get it back, you must either sell the home, incurring a 6% transaction fee, or apply for a home equity line of credit. But here's the structural anxiety. If you have lost your income, no bank will approve you for a loan, regardless of how much equity you have. You become house poor, asset-rich on paper, but completely cash poor, and vulnerable to default. Layer number 2 is the opportunity cost. While you are saving 6.5% on debt interest, you are bypassing the historical compounded returns of the broader market. According to long-term data from the Center for Research and Security Prices, the historical nominal return of the S&P 500 over any 20-year period has averaged approximately 10%, or roughly 7% when adjusted for inflation. By choosing the mortgage, you are willingly accepting a structural negative 3.5% per year on every single dollar used. Layer number 3 is the inflation erosion. A fixed-rate mortgage is one of the few financial instruments where inflation actually works in your favor.
Your monthly principal and interest payment of $2,275 is locked for 30 years. As inflation reduces the purchasing power of the dollar by an average of 2.5% annually, the real economic burden of that fixed payment drops every single year. Rushing to pay off a depreciating liability with high-value current dollars
is an inverted use of capital. To understand how these compounding forces alter your actual life trajectory, let us run a 20-year simulation comparing two distinct strategies. Both strategies start with our baseline 30-year mortgage of $360,000 at 6.5%, with a standard monthly principal and interest payment of $2,275. Both strategies have an extra $500 of disposable income per month. Strategy A, the debt destroyer, applies the extra $500 directly to the mortgage principal every month. Strategy B, the strategic investor, maintains the standard mortgage payment and invests the $500 monthly into a low-cost S&P 500 index fund, assuming an average 10% nominal return. Let us look at checkpoint 1, year 5. For strategy A, the extra payments have reduced the mortgage balance down to $298,000 compared to the standard balance of $331,000. They have saved several $1,000s in cumulative interest. However, their liquid investment cash is zero. For strategy B, the mortgage balance remains at the standard $331,000, but their investment account, compounding at 10%, has grown to $38,700. Strategy B already possesses a massive liquidity buffer that strategy A completely lacks. Let us look at checkpoint 2, year 10. For strategy A, the accelerated payments are showing significant progress. The mortgage balance has dropped to $211,000. The homeowner feels a deep sense of accomplishment. But let us check strategy B. The mortgage balance sits at $291,000. However, their investment portfolio has experienced the compounding snowball effect, growing to more than $103,000. At this exact milestone, the total net worth of both strategies is mathematically comparable, but strategy B has over $100,000 of highly liquid, accessible capital, ready for any market opportunity or life emergency, while strategy A's wealth is entirely locked in drywall and concrete. Let us look at checkpoint 3, year 18. This is the moment strategy A has been waiting for. By consistently contributing the extra $500 a month, the mortgage is completely paid off, 12 years ahead of schedule. Their monthly housing payment drops to zero, saving them a total of over $120,000 in lifetime interest. The psychological relief is immense. But let us look at the true cost of that relief by analyzing strategy B at this exact same 18-year mark. Strategy B still owes approximately $174,000 on their standard mortgage, but their investment account has been compounding relentlessly. That $500 a month, growing at 10% nominal, has blossomed into a staggering $312,000. Think about this deeply. Strategy B could write a check tomorrow to completely pay off their entire mortgage balance of $174,000, and they would still have $138,000 of pure liquid cash left over in their investment account. Strategy A has a paid-off house and zero investments. Strategy B has the exact same paid-off house, plus an extra $138,000 in cash. By year 20, the trajectory widens even further. Strategy A, now debt-free, begins redirecting their full lifestyle capacity into investing, but they have missed 2 decades of compounding. Strategy B's investment portfolio has swelled to $400,000, while their remaining mortgage is a tiny inflation-diluted remnant. The real math shows that paying off the mortgage early results in a massive net worth penalty. This is a critical macro calculation, and it is important to remember that this is not personalized financial advice. You should always consult a certified financial advisor for your specific situation. To maintain absolute intellectual honesty, we must examine the specific conditions under which strategy A actually wins. First, this calculation shifts dramatically if your mortgage interest rate is exceptionally high. If you bought or refinanced a home during a high-rate cycle where mortgage rates exceeded 8 or 9%, the guaranteed return of paying down that debt begins to rival or exceed the historical net real return of the stock market. In that specific scenario, paying down debt becomes mathematically defensive and highly rational. Second, we must account for human psychology and behavioral execution. The strategic investor strategy only works if you actually invest the $500 every single month. If you maintain the mortgage but spend the extra $500 on lifestyle inflation, vacations, or depreciating vehicles, you lose on both fronts. Paying off a mortgage acts as a form of forced savings for individuals who lack the behavioral discipline to consistently invest. The higher-level financial principle here transcends housing entirely.
True financial security is not determined by the absence of liabilities, but by the presence of liquidity and cash flow flexibility. Debt optimization, when executed with historical math and behavioral control, allows you to put your capital where it treats you best. Do not let the emotional desire for a debt-free milestone blind you to the overwhelming power of long-term asset compounding.